In 1620, the richest city on earth had no king, no court, and no natural resources whatsoever. Amsterdam was built on a swamp. It sat on wooden piles driven into wet peat, in a country that had to be pumped dry every single day, or it would simply cease to exist. The Dutch Republic had no gold mines, no silver mines, no timber worth speaking of, barely enough farmland to feed itself. It had rain, mud, herring, and roughly 1.5 million people, fewer than the population of Paris, and it owned the world. Dutch ships carried more cargo than the fleets of England, France, Spain, and Portugal combined. Dutch merchants set the price of pepper in Europe, the price of silver in Japan, the price of grain in the Baltic. The Bank of Amsterdam held the deposits of half the continent. And in a courtyard just off the dam, under a covered colonnade with a clock on the wall, a few thousand men gathered every day between noon and 2 to buy and sell something that had never existed before in human history. Not spices, not silver, not ships. They were buying and selling pieces of a company. The Dutch didn't just build an empire, they built the machine that would build every empire after them. And that machine, as we're about to find out, has no loyalty to the people who invent it. Because by 1799, less than 2 centuries later, the greatest corporation the world had ever seen would be dissolved with a debt of 219 million guilders. The Bank of Amsterdam, the most trusted financial institution in Europe, would be exposed as a hollow shell. The Dutch Republic itself would be gone, occupied, absorbed, erased from the map. And the men who had invented modern finance would watch their entire civilization be liquidated by the exact instruments they had created. So what does the most sophisticated financial power on earth do when it discovers it has invented something it cannot control? It does not panic. It does not reform. It writes one more line in the ledger. That line, a single clause, added almost as an afterthought to the first page of a subscription register in the summer of 1602, is the reason you can open an app on your phone right now and own a fragment of a company you will never visit, run by people you will never meet, in a country you may never see. Now, this is a story most people think they already know. Tulips. Silly Dutchmen paying the price of a canal house for a flower bulb. A cautionary tale about greed, filed away between the South Sea bubble and the dot-com crash, told with a chuckle. But that version is not just incomplete. It is a decoy. The Tulip Mania is the story people tell because it is the comfortable story. It lets us laugh at other people's stupidity. What actually happened in Amsterdam is far stranger, far more sophisticated, and far more relevant, because the Dutch did not destroy themselves with a flower. They destroyed themselves with an accounting decision, a permanent capital structure, and a bank that lied about what was in its vaults. This is the full story. To understand what happened, you first have to understand what came before, because the thing the Dutch invented was not the company. Companies existed. It was not investment. Investment existed. It was something much narrower and much more explosive. Before 1602, the way you financed a voyage to Asia was simple and brutal. A group of merchants pooled their money. They bought a ship, they filled it with silver and cloth, and they sent it around the Cape of Good Hope, into waters that would kill roughly 1 in 3 of the men aboard. Well, if the ship came back, and often it did not, you sold the cargo, you counted the money, you paid everyone out, and the partnership dissolved. Then, if you had the stomach, you did it again. Every voyage was a separate company. Every company had an expiry date. Your money went out, and either it came back or it drowned. This system had one fatal flaw, and the Dutch discovered it the hard way. In the 1590s, there were 6 separate Dutch companies sending fleets east. They competed. They bid up the price of pepper in Java and drove down the price of pepper in Amsterdam. They fought the Portuguese separately and badly. They were, in the words of the Grand Pensionary of Holland, Johan van Oldenbarnevelt, ruining each other for the profit of Spain. Oldenbarnevelt's solution was radical. He forced them to merge. On the 20th of March, 1602, the States General granted a 21-year charter to a single entity, the Verenigde the United East India Company, the VOC. The charter had 46 articles, and most of them were about war. The VOC was given the right to maintain armies, to build fortresses, to mint its own coinage, to sign treaties with sovereign kings, to wage war east of the Cape of Good Hope in the name of the Dutch Republic. It was, from the first day of its existence, not a company that had a government. It was a company that was a government, one with a balance sheet. But the article that changed the world was Article 10, and it was 5 words long in substance. All the residents of these lands may buy shares in this company. All the residents. Not the guilds, not the patricians, not a closed syndicate of 40 merchants in a back room. Anyone, and there was no minimum investment and no maximum. When the subscription books opened in August of 1602, 1,143 people in Amsterdam signed their names into the ledger. The directors, Gerrit Bicker, Reinier Pauw, Jan Poppen, and the rest, put in 12,000 guilders each, enough money to buy 6 houses on a canal, and near the bottom of the last page, second from the end, there is an entry for 100 guilders in the name of Neeltgen Cornelis. She was a maid. She worked for one of the directors. She earned less than 50 cents a day, and she had watched investors walking in and out of her employer's house for an entire month. And on the last night before the books closed, she put down 200 days of her wages to own a piece of the Indies. At midnight, the notary closed the register. The Amsterdam Chamber had raised 3,674,945 guilders. Across all 6 chambers, the total came to roughly 6.5 million. It was the largest sum of capital ever assembled by a private enterprise in human history. And the English East India Company, founded 2 years earlier, had launched with the equivalent of about £68,000, a rounding error by comparison. But here is the critical detail that changes everything. The money was not coming back. Under the charter, the capital was locked in for 10 years. There would be no settling of accounts after each voyage, no dissolution, no payout, no exit. The VOC was designed to be permanent, and permanent capital was the single most revolutionary idea in the entire document, because it meant the company could build warehouses, garrisons, shipyards, and colonies. It could think in decades, it could compound. And it also meant that 1,100 people had just handed over their savings with no way to get them back. The directors seem to have realized this problem very late, after the charter was signed, and possibly after the books were already open. Because somebody, at some point that summer, wrote an extra provision onto the first page of the subscription ledger. It is one clause. It is easy to miss. In translation it reads, "Conveyance or transfer may be done through the bookkeeper of this chamber." Consider what that means for a moment. If you could not get your money out of the company, you could still get out of the company by selling your place in it to somebody else. Your share was locked, but your share was now transferable. That single sentence, added as an administrative convenience by men trying to make an offer more attractive, created the secondary market. It created the shareholder as we know him. It created the price. It created every trading floor, every ticker, every index, every crash, every fortune, and every ruin that has followed for 424 years. They were not trying to invent the stock market. They were trying to close a sale. The trading began almost immediately, and it began in the open air. The first share transactions in world history took place on a bridge, the Nieuwe Brug, near the harbor, where merchants gathered to meet the incoming mail boats and hear the news before anyone else. Then it moved indoors. In 1611, the city opened a purpose-built exchange designed by Hendrik de Keyser, a rectangular courtyard ringed by a colonnade with numbered pillars open to the sky. It was a commodities market for most of the day, but in one corner, near pillars 24 through 30, men traded VOC shares. The exchange was open for exactly 2 hours, from noon until 2. A bell rang, and it emptied. And then everyone walked around the corner to the dam, or into the coffee houses, and kept trading anyway. Within 4 years, the price of a VOC share had risen by 200%. The company had not paid a single dividend. It would not pay one until 1610, and when the dividends finally came, they were sometimes paid not in money, but in mace, in cloves, in pepper, in nutmeg, because the company had spices and no cash. Investors were being handed sacks of spice as dividends and going out to sell them on the market. Which raises an obvious question, and it is a question that would take Amsterdam the better part of a century to answer honestly. If the price of a share can rise 200% while the company has never once returned a guilder to anybody, what, exactly, is the price of? Now into this new machine steps a man who understood the answer before anybody else did, and who used it to try to destroy the company he helped create. His name was Isaac Lemaire. He was born around 1558 in Antwerp, and he came to Amsterdam as a refugee when the Spanish took his city. He arrived with nothing and built a fortune in Baltic grain and Asian pepper, and by 1602 he was rich enough that when the VOC subscription books opened, He put in 85,000 guilders, the single largest investment of any of the 1,143 founding shareholders. He was on the board. He was, by any reasonable measure, one of the founding fathers of the modern corporation, and on the 22nd of February, 1605, he was thrown out of it. The company accused him of embezzlement, of running private trades on the side, of using VOC information for his own account. He was forced to resign, and as a condition of his departure, he was made to sign a declaration promising that he would never again involve himself in any enterprise trading beyond the Cape of Good Hope or the Straits of Magellan. They didn't just fire him, they banned him from the sea. Lemaire spent the rest of his life trying to break the VOC, and in 1609 he found the weapon. He formed a syndicate, a private partnership of about 9 men, and they began to sell VOC shares. Not shares they owned, shares they didn't own. They wrote forward contracts, agreements to deliver stock at a fixed price on a future date, in the confident expectation that when the date arrived, the price would be lower, and they could buy the stock cheaply, deliver it, and pocket the difference. This is short selling. This is the first bear raid in recorded history. And it was executed within 7 years of the invention of the share itself. There was no collateral required, there was no clearinghouse, there was nothing standing behind the contract except a signature and a reputation. And Lemaire's syndicate did not simply place their bets and wait, they went to work on the narrative. They spread rumors in the coffee houses, reports of ships lost, reports of massacres in the Moluccas, reports of the French preparing a rival company. They understood, 400 years before anyone had a word for it, that in a market, the story and the price are the same object. The VOC directors were horrified. They petitioned the States General with a complaint that sounds startlingly modern. These men were selling something they did not possess, driving down the value of an honest enterprise, and ruining widows and orphans who had been persuaded to invest. And on the 27th of February, 1610, 8 years after the invention of the stock market, the Dutch Republic passed the first ban on short selling in the history of the world. It did not work. The trade simply moved. The ban applied to contracts that could be enforced in court. So the traders stopped using the courts. They settled among themselves, on their word, in the coffee houses, in a shadow market that everyone knew about and no one could touch. The Dutch even gave it a name. They called it windhandel, the wind trade. Because you were not trading ships, or pepper, or silver, or anything you could put your hands on. You were trading air. And here is where the story stops being a business history and becomes something closer to a psychological thriller, because once you can trade the wind, the market stops being about the company at all. By the middle of the 17th century, Amsterdam had invented, in rough order, forward contracts, options, puts and calls, priced and traded, repurchase agreements, where you sold a share and agreed to buy it back later, which is to say margin lending, short selling, and something called the Ducaton share, a derivative worth 1/10 of a real VOC share, invented purely so that small speculators could bet on the price without ever touching the underlying stock. It settled in cash. It conveyed no ownership of anything. It existed only to place a wager on a number. They built the entire architecture of modern finance in about 70 years, in a courtyard, with quill pens. We know how it felt from the inside, because of one extraordinary book. In 1688, a Sephardic Jewish merchant named Joseph de la Vega, a man who had made and lost fortunes on the exchange himself, published a strange, feverish dialogue in Spanish called Confusión de Confusiones. It is the first book ever written about the stock market, and reading it today is a genuinely unnerving experience, because he describes the exchange not as a marketplace, but as a kind of collective delirium, a place of enigma, of theater, of men who are certain and men who are ruined, a business he calls both the fairest and the most deceitful in Europe. He also lays down rules for the speculator that would not be out of place in a modern trading manual. Never advise anyone to buy or sell. Accept both your profits and your regrets with the same face, and whoever wishes to win in this game must have patience and money, since the values are so little constant. The values are so little constant. That is a man in 1688 telling you that the price is not the thing. The price is a rumor about the thing. Now we need to talk about the tulips, because if we don't, somebody in the comments will, and because the tulips are the perfect illustration of how badly we have been taught this history. Between roughly 1634 and February of 1637, the price of rare tulip bulbs in the Netherlands rose to genuinely absurd levels. A single bulb of the variety Semper Augustus, white, with flames of crimson running up the petals, a pattern that was in fact caused by a virus infecting the plant, was reportedly valued in the thousands of guilders. Contracts changed hands in taverns, settled in wine, written on scraps of paper, and then in the first week of February 1637, at a routine bulb auction in Haarlem, there were no buyers. The price went to nothing in a matter of days. It is the most famous financial mania in history, and it was, in the cold light of the archives, close to irrelevant. The tulip trade was largely conducted outside the exchange, by artisans and small traders, in a market for a luxury good, during a plague outbreak, with contracts that were mostly never enforced, and losses that were largely absorbed by settling at a small percentage of the agreed price. Modern economic historians have gone looking for the wave of bankruptcies that supposedly followed. They have struggled to find one. The Dutch economy in 1637 did not crash. It kept growing for another 35 years. So why do we all know about the tulips? Because the tulips are a moral story, and moral stories are easy to sell. Greedy fools bought a flower. The flower was worthless. They were punished. The end. The real story has no fools in it. That is what makes it frightening. The real story is about the smartest, most sophisticated, most financially literate people who had ever lived, and it does not end with a bulb auction in Haarlem. It ends with a bank. Because there was one more institution the Dutch invented, and it is the one nobody talks about, and it is the one that killed them. In 1609, 7 years after the VOC, 2 years before the exchange building, the city of Amsterdam founded the Wisselbank, the Bank of Amsterdam. Its purpose was to solve a filthy, unglamorous problem. Europe in 1609 had hundreds of different coinages in circulation, clipped, debased, shaved, and forged. No merchant could trust the metal in his hand, so the city created a public deposit bank. You brought in your coin of whatever origin. The bank weighed it, assayed it, and credited you with bank money, a ledger entry, backed by metal sitting in the vault under the town hall. Bank money could not be debased. It could not be clipped. It was, for the first time in European history, a currency that was purely a number in a book, and it was trusted so completely that it traded at a premium to actual coin. That premium was called the agio. For most of the 17th century, it sat at 4 or 5%, and it barely moved. Adam Smith wrote about the Wisselbank with something close to reverence. Its rule was absolute and famous. It did not lend. It was a warehouse for metal, not a bank. Every guilder of bank money was matched by a guilder of silver in the vault. Every merchant in Europe believed that. It was not true. Quietly, over decades, the Wisselbank had begun making loans, unsecured loans, off the books, to the city of Amsterdam, to the Society of Suriname, and above all to the VOC. The company, whose cash was permanently at sea in the form of ships and pepper 18 months from market, needed bridging finance, and the bank was right there, and the men who ran the bank and the men who ran the company were, in many cases, the same men, sat on the same councils, married into the same families, drank in the same rooms. They called the loans anticipations, advances against cargo not yet arrived, and the bank's books were secret. They had been secret for 2 centuries. Nobody outside a handful of regents had ever seen a balance sheet. Now here is where the threads converge in a way that is almost too neat to be coincidental. Look at what the VOC had become by the 18th century. It had raised equity exactly once, in 1602, and never again. Not in 200 years. Its paid-in capital was frozen at 6.5 million guilders, while its operations grew to 50,000 employees and a private navy. Every guilder of expansion after 1602 was financed by retained earnings or by debt. The company issued bonds. Amsterdam bought them. And the dividends? The VOC paid dividends of, on average, something like 18% a year across its lifetime. Magnificent. Legendary. The best return in Europe. Except that from around 1730, the dividends the company paid out began to consistently exceed the profits it was actually making. Read that again. For the last 70 years of its existence, the greatest corporation in the world was paying its shareholders out of borrowed money. It could not cut the dividend. The dividend was the share price, and the share price was the collateral, and the collateral was in the vaults of the Bank of Amsterdam, and the Bank of Amsterdam was lending to the VOC to keep it solvent so that it could keep paying the dividend that supported the share price that backed the loans. The machine had closed into a circle, and no one could see the whole circle, because the bank's books were sealed. The end, when it came from the sea, as it always had. In 1780, Britain declared war on the Dutch Republic, the Fourth Anglo-Dutch War, nominally over Dutch trade with the rebellious American colonies. It lasted 4 years, and it was a catastrophe. Within weeks, the Royal Navy had taken more than 200 Dutch merchantmen with 15 million guilders of cargo aboard and bottled up 300 more in foreign ports. The VOC lost roughly half its fleet. Its direct losses ran to something in the order of 43 million guilders. Its Asian trading network, built over 180 years, was cut apart in 48 months. By the 1780s, the company's debts had passed 100 million guilders, and it was surviving purely on loans from the Dutch state. And the agio, the premium on bank money, that unbroken 170-year-old signal of absolute trust, began to fall. 4%, 3, 2, 1. In 1790, the Bank of Amsterdam, the most respected financial institution in the world, quietly admitted it could not honor its own deposits, and offered to sell silver to its depositors at a 10% discount. In 1791, the city took direct control, and in March of 1795, after French revolutionary armies had marched into the Republic and the new revolutionary city council took possession of the town hall, they did something no one had done in 186 years. They opened the bank's books and published them. For the first time in 2 centuries, the merchants of Europe saw what was actually in the vault under the dam, and what was in the vault was a hole. The uproar was total. The bank never recovered. Attempts were made to raise a rescue loan. Almost nobody subscribed. The revolutionaries then announced that the old regents would be held personally liable for the loans they had made in secret, which tells you exactly how the city felt about what it had just read. The VOC was nationalized on the 1st of March, 1796. Its charter was allowed to expire on the 31st of December, 1799, the last day of the century it had defined. The state absorbed its possessions and its debt. The debt was 219 million guilders, Neiltgen Cornelis's 100 guilders, and every guilder that had ever been subscribed in that ledger was gone. The Republic itself was gone, folded into the French Empire. The Bank of Amsterdam was wound up in 1820 without ceremony. Amsterdam never again ran the money of the world. Now, I want to be very careful here, because this is a topic where lazy morals flourish, and where the neat version is almost always the wrong one. There are people who will tell you that the Dutch were destroyed by speculation, that the stock market is a casino, that the derivatives and the short sellers and the wind trade hollowed out an honest merchant republic, and that this is the lesson. That framing is too clean, and it is wrong. The Amsterdam market was not a casino. It was, by a wide margin, the most sophisticated market on earth, and it was right far more often than it was wrong. Lemaire's bear raid was based on an accurate reading of a company that had paid nothing to its investors in 7 years. The short sellers were not parasites. They were the only people in Amsterdam whose profit depended on telling the truth about a bad company. The Tulip Mania did not wreck the economy. The 1720 wind trade, the Dutch cousin of the South Sea and Mississippi bubbles, in which some 40 new companies were floated between June and October, and the whole thing collapsed on the 5th of that October, did far less damage in Amsterdam than in London or Paris, precisely because the Dutch market was mature enough to be skeptical. The stock market did not destroy the Dutch Republic. The stock market worked. But it is equally naive, perhaps even dishonest, to pretend that the machine had nothing to do with it. Because here is what the machine did. It made capital permanent, and a company with permanent capital never has to face the moment of reckoning that the old single-voyage partnerships faced every time a ship came home. There was no settling of accounts. There was no day on which the books were closed and the truth was told. The VOC never had to stop. For 197 years, it never once had to look its owners in the eye and say, "Here is what we actually have." And so it didn't. It paid dividends it had not earned, because the market wanted dividends. It borrowed to pay them, because the market would lend. And the bank that everyone trusted, staffed by the same families, lent against assets that were 18 months away and might already be at the bottom of the Sunda Strait, and it kept its books shut, because that had always been the rule, and because the alternative was to say out loud what everyone half knew. That is not speculation. That is the opposite of speculation. Speculation is a bet that can be lost. What Amsterdam built, in the end, was a bet that could never be settled. What we can say with confidence is this. The Dutch collapse was the product of several converging pressures: a ruinous war, a corrupt colonial administration, a permanent capital structure with no mechanism for honesty, a dividend policy that had detached from earnings, a public bank that had quietly become a private lender to the largest debtor in the country, English competition, and 2 centuries of accumulated institutional rot. No single factor explains it, but to tell the story of the Dutch Golden Age without the ledger, which is what most popular histories do, with their tulips and their Rembrandts, is to tell a story with its spine removed. The real lesson of the Amsterdam Exchange is not that markets are dangerous. Every generation learns that and forgets it and learns it again. The real lesson is stranger and more unsettling than that. It is that the instruments we build to measure value eventually become the thing we are trying to measure. The price of a VOC share began as a claim on pepper in a warehouse in Batavia. It ended as a claim on the price of a VOC share. The bank money in the Whistle Bank began as a claim on silver in a vault. It ended as a claim on the credibility of the men who said the silver was there. And when an institution becomes too important to be honest about, it will not be honest. Not because the men running it are villains. They were not villains. They were regents and burghers and church-going merchants who genuinely believed they were holding the republic together, but because the cost of telling the truth on any given morning is always higher than the cost of waiting one more day. They waited one more day for 186 years. And the people who paid for it were not the regents. They never are. It was Neeltgen Cornelis and the 1,142 others whose names are still legible in that ledger in The Hague, and their grandchildren, and their great-grandchildren, and the sailors, and the people of Java and Ambon and Banda, who were conquered so that the dividend could be paid. And there is a final irony worth sitting with. The machine survived. Everything the Dutch invented in that courtyard, the tradable share, the permanent company, the secondary market, the option, the short sale, the central bank, the funded public debt, all of it was exported. It crossed the North Sea with William of Orange in 1688, and within 6 years London had a Bank of England, and within a century it had an exchange, and within 2 centuries the entire apparatus had crossed the Atlantic. The Dutch built the operating system of the modern world, and then were deleted by it. The republic that invented the future did not get to have one. 1602 was the year the old world ended and the new one began, not in a palace, not on a battlefield, but in a subscription ledger in Amsterdam, in a clause that somebody added at the last minute so that a maid could change her mind. And we are all, every single one of us, still living inside the sentence they wrote that night. If you made it this far, drop a tulip emoji in the comments so I know you stayed until the end. And if you haven't already, please subscribe. It genuinely makes a bigger difference than you'd think, and it helps this kind of deep dive keep coming. I'll see you in the next one.